Welcome to all. I'd like to start our conversation regarding the corporate finance course with a very summarized view of what we're about to cover. We have a lot in our hands. We will go on from financial statement analysis and forecasting, um, proceed onto the time value of money concept, which is really the concept that allows us to make decisions today based on outcomes that we expect at some future point in time. We use this concept, the time value of money concept, to value bonds and stocks. And let me modify this a bit. Okay. And so use the time value of money concept to basically help us find the value of financial assets. We then talk about the relationship that needs to exist between risk and return, right? Compensation has to be a function of how much risk we bear. How do we measure that risk? How do we measure that return? And with that, we're going to be able to estimate our company's cost of capital, a very critical component that is needed in order to make investment decisions, which is capital budgeting, and in order to do also any valuation related exercise. So that's the plan. The first, I guess, conversation we need to have is what is the objective of a financial manager? And the argument is, we have to maximize value, right? But which value? We've all heard about stock price value. And the conversation there is the stock price necessarily the value that best reflects, how much a company or how much a series of assets are worth? The answer to that is that it is what people agree that's an asset or a company is worth. But we're going to emphasize that in financial management, we're trying to maximize what we call the intrinsic value. The intrinsic value is the value that you assign to an asset or to a company if you had all relevant information at your disposal. And this is very important, right? Having relevant information, because if you know, for example, that a company is maximizing its profits by irresponsibly exploiting natural resources, then while the profitability can rise, let's say, and since we're part of an international group, I'm just going to talk in dollar terms. If your stock price is worth $10 and because of this cheating that you're actually implementing, right, this unsustainable or unethical use of resources, you've been able to minimize your costs and increase your profitability, your stock price can reach $15 because you are, sending an incorrect signal that your profits are higher. They're higher because you're not doing the right thing and subject to potential litigation and legal issues. If on the other hand, you look at this $15 per share, per stock price, and you say, well, what would happen if the market were to find out what this company is up to? If you knew that they were going through illegal, and unsustainable processes, then when the market finds out, you will more likely see that stock price fall, right? And it could fall even, to below the previous $10 value. So which is the intrinsic value, right? The intrinsic value at this point is knowing all the information that we know. This is how much this company is worth, because now we have to incorporate all the litigation and all the legal costs that may come from the consequences of this unethical behavior. So when you talk about financial managers trying to maximize a value, which one are they going to try to maximize? We would hope that they maximize the intrinsic value, the value that we would assign to the company if we were to know all there is to know about that's relevant to its value. So you're not really trying to manage it for the short term. You're trying to manage the company and maximize the value in the long term. So maximize intrinsic value means that you are making decisions that will sustain and support a higher value for the owners of your company in the long term. Now, what is intrinsic value? This doesn't look very user-friendly, I know, at this point in time. Let me just give you a very intuitive explanation, right? The value is a function of two things. It's a function of the cash flows that you can generate, and those what we call free cash flows. That's why it's FCF. And those cash flows occur every period. The period could be every year, every month, depending on your forecast, right? But for now, just understand. I hope it makes sense to you. The value is just a function of the cash flows that a company is able to generate, and those cash flows are just the revenues and then subtracting any costs, subtracting any additional investments in operating capital. What are those? If you are expanding, then what are the additional investments in operating capital that you have to plan for? Well, at the very least, expansion of, you'll say, some property or equipment, right? If you're also growing, then you may have to invest in additional working capital, such as adding on to your inventory and so on. So all of these additional investments have to be accounted for. When all of these costs are accounted for, whatever is left, that's what's really free cash flows. Those are the cash flows that are free to be paid to all our providers of funds. Who are our providers of funds? Well, the owners of the company that have provided money for the company to be created and to operate. And if we owe money, if we borrow money from any lender, they have to be paid too. So think of free cash flow as a cash flow that's really free to be paid to all providers of funds, our shareholders, our owners, and our creditors, our lenders. And that, the higher that is, the more valuable a company is. On the other hand, you do realize that the higher the free cash flows, just mathematically, as you can see, then the higher the value, the intrinsic value of a company. But on the other hand, please remember that that money has to come from somewhere, right? Where is that somewhere? It comes from our owners, our equity holders, right? And our debtors or lenders, right? The people that lend us money. If let's say right now that we borrow from equity holders and we offer them a 20% return. In other words, if you give me $1,000, then I promise you that every year you should expect to receive a 20% return on those $1,000, so $200 every year, right? And if people lend me money and they will lend me money at, say, 10%. The reason why they ask for less is because lenders are more protected than equity holders, right? Lenders get paid first. What is the cost of capital? Okay, which is what you see here, the denominator. The weighted average cost of capital is just simply the average of the cost of the funds that we seek to use in order to make the firm operate. So if I can borrow, let's say, half of my funds, so if the weight for equity is 50%, half of my funds come from equity holders that want and expect a 20% return. And the other half of my money comes from debt holders, the other half, 50%, that expect a 10% return, then what is my average cost of capital? It's easy because since I use equal weights, then we know that the average cost of capital is going to be 15%. What does that mean? That all the money that I gather from equity holders and from lenders, I have to make sure that I use it in such a way that I earn a 15% of that money as a compensation every year. If I earn 15%, I'm going to be able to pay 10% to half of my providers of funds and 20% to the other providers. So think of it this way. Value is a function of two things. First is how much cash I can generate, and the second thing is how much is the cost of that cash. The higher the cost, the higher the WACC. So in my example, it's 15%, right? If my cost goes up to 20% or to 25%, what happens to my denominator? It becomes larger. What happens to the value of my company? It becomes smaller. So a company, all else equal, the company that generates the same free cash flows as other companies, but has a higher cost of capital, that company is less valuable because it's more costly for it to operate. I hope that this makes sense to you, right? Now, the cost of capital is going to be a function of the cost of debt, as I said before, and the cost of equity. Just to give you just a small explanation, these two things affect the cost of debt and the cost of capital and the cost of equity. And it's kind of like reasonable to say that, well, if interest rates go up, then that means that, of course, the cost of borrowing from these two different groups has to go up too. If the market gets more nervous, market risk aversion, right? If the market is more nervous, what happens when people are more nervous? They ask for more compensation. So again, if the market is more nervous, then we should also see the cost of debt and the cost of equity increase. Those two are more intuitive. These two are not always as intuitive, so let me explain them. If you are lending to a company, right, to two different companies, you do exactly the same thing, but one company has no debt and the other one has debt, which one do you perceive as riskier? Your answer would probably be, yeah, I feel like the one that has debt is riskier than the one that has no debt at all. If you feel that they're riskier because they have a higher amount of debt, so the debt to equity mix, right, is higher. We call it having more leverage or more debt. What are you going to do? You're going to demand more compensation in exchange for the money that you provide to that company. So the higher the cost, the ratio of debt and equity, that affects how much lenders and providers of funds demand as compensation, and that therefore affects my cost of capital. So the higher this mix, right, the higher the cost of capital. The higher the business risk, again, also affects the cost of capital. If there are two companies, one is a technology company, one is a very stable company, utility company, for example, which one do you perceive as riskier? Well, the one and I mean, imagine that both have zero debt, so no debt at all. So don't worry about that. If you compare the business risk, the risk of being a utility company that has very stable demand, right, with the risk of being a technology company that's very promising, but it's growing, there's a lot of competition, there's a lot of innovation. Which of the two would you perceive as riskier? Probably a technology company, right? So the business risk is also a function, an input that affects our cost of capital. So think of our cost of capital as being a function of the things that are happening in the market and a function of the characteristics of that firm. What kind of firm is this, right? Is this a firm that's typically a safe firm, a stable firm, or is this a firm that has more leverage? The answer to those two questions will also affect the cost of debt and the cost of equity. Therefore, it will affect the cost of capital. And whatever affects the cost of capital will affect firm value. So intrinsic value is just basically, and don't worry about the formula that you see there in green, right? I will explain this further as we go along the course. But for now, all you need to take from all this conversation is that value is a function of basically two general things, right? One is how much cash a company is able to generate, and the other is at what cost is this company able to collect and gather and raise the money that it needs to operate. The higher the cost, the less value of the company. The more free cash it can generate, the more value the company. And lastly, before we begin our ratio conversation, think of ratios are just as performance measures, right? A ratio is just one number divided by another number. That's all, right? As long as that information is useful, it's a financial ratio. We call them financial ratios because generally the inputs that we use in order to determine what a liquidity ratio is or what a profitability ratio is, that information comes from financial statements, right? They're financial ratios because we use financial statements in order to be able to use this information. So think of financial ratios as just a ratio of two different numbers that come from our financial statement information. And we'll go more into this as we proceed into the module. The two financial statements that we're going to use primarily are the income statement and the balance sheet. In your financial accounting course, right, you've already seen the balance sheet and income statement as well as the free cash flow statement. All I want you to remember, so I'm not going to revisit this, but all I want you to remember is that the income statement is really, it gives you flow measures, right? In the income statement, what you see is, let's say the net income for the year. It's how much net income you've generated throughout the 12 months that precede the financial statement publication. While the balance sheet is a snapshot, right? It's a snapshot. It's a static measure. It's not a flow measure. It's a static measure, right? So if I see, for example, let's say cash, the cash at the end of 2017 for this company, right? It's not the cash that has been generated throughout the year. It's a static measure. As of the end of 2017, this is how much we had in cash. So it's a snapshot. So think of the income statement as providing flow information and the balance sheet as providing a static or a snapshot information. The balance sheet is very interesting because, as you may have already seen, and this is just a refresher, right? The asset side tells you where the money has gone, while the liability and equity side tells you where the money is coming from. So the money is being raised, it's coming from the asset and liability side, and it goes to the equity and liability side, and it goes to the asset side. So think of the liability and equity as telling you where the money is coming from, and the asset side telling you where the money has been spent. Obviously, for the balance sheet to balance, both have to be the same. All right, so just remember those two things as we proceed in our conversations in the following material.